Hello chart explorers and welcome back to Explain the Charts. Today, August 5th, 2025, we're diving deep into the recent turbulent waters surrounding Amazon, ticker symbol Amazon. The market has seen a significant shakeup with Amazon stock, particularly after its latest earnings report. Recent news headlines, like those from Forbes, confirm a dramatic 8% fall in Amazon shares following a mixed second quarter report. This sharp decline is largely attributed to the slower-than-expected growth of Amazon Web Services, or AWS, especially when compared to rivals in the generative AI market. Analysts are expressing skepticism regarding AWS' ability to effectively compete in this new AI age, with CEO Andy Jassy's explanations during the earnings call being described as unconvincing. It appears the market is heavily scrutinizing AWS strategy, which requires more technical expertise from developers, a stark contrast to the integrated proprietary AI chatbots offered by competitors. Despite some analysts maintaining a slightly undervalued rating with price targets in the $255 to $261 range, the immediate sentiment is clearly bearish. Now, let's look at the daily chart to see how this news manifested in price action. If we focus on the candles leading up to the earnings announcement, we can clearly identify the pivotal moment. The candle for July 31st, just before the news hit, shows Amazon closing around $234.11. The very next day, August 1st, we see a massive bearish gap down, opening significantly lower around $217.21 and closing at $214.75. This immediate drop of over 8% perfectly aligns with the negative sentiment from the earnings report, demonstrating how quickly fundamental news can impact price. Prior to this, the stock had been in a fairly consistent uptrend since late 2024, making higher highs and higher lows, suggesting strong bullish momentum. However, this recent event has initiated a clear reversal of that short-term bullish trend. Looking at the August 4th candle, the stock continued its descent, closing at $211.65, pushing further into bearish territory. This confirms that the selling pressure is persistent beyond just the initial shock. From a technical perspective, the $230 to $235 zone, which acted as a support area earlier in July, has now clearly flipped into a strong resistance level after this significant breakdown. The current price action is testing a new, crucial support level around the $210 to $212 range, particularly indicated by the low of $211.42 on August 4th. Switching to the one-hour chart gives us a more granular view of the immediate aftermath of the earnings report. We can observe the intensity of the selling pressure directly following the news release on July 31st. The volume surge on these hourly candles during the initial drop is extremely high, indicating a strong institutional sell-off and widespread panic among investors. This heavy volume confirms the conviction behind the bearish move. The price struggled to find any significant bounces, suggesting that sellers were in firm control. Notice the failed attempts to recover above the $225 level, which quickly became an immediate resistance point on this time frame. Now, let's narrow in even further on the 15-minute chart to capture the raw volatility of that earnings announcement. Zooming into the period around July 31st, 1956 Universal Time Coordinated, you can clearly see the dramatic collapse. The candle that opened at $234.28 and plunged to a low of $227 with massive volume illustrates the immediate market reaction. The subsequent candles show minor rebounds quickly met with more selling, forming lower highs and lower lows. This confirms extreme short-term bearishness and the capitulation of many buyers. For day traders, identifying these rapid shifts and high-volume drops is crucial for scalp trading or confirming breakout directions. The rapid move through previous intraday support levels without significant buyer intervention suggests a powerful downside momentum. Returning to the daily chart, let's consider the broader implications. From a bullish perspective, the stock is now trading significantly below its analyst consensus target of $255.72 to $261.05. This could present a long-term buying opportunity if you believe Amazon can address its AWS growth challenges and innovate in AI. The company's retail segment continues to perform strongly, which could provide a floor for the stock in the longer run. However, the immediate bearish case is strong. The 8% drop was a clear break from its established uptrend, signaling a shift in market sentiment. Concerns over AWS AI strategy and competitive positioning are significant fundamental headwinds. Increased capital expenditures, while necessary for growth, will also weigh on short-term profitability, making the path to recovery potentially bumpy. For traders, the current key price levels are critical to watch. The immediate resistance is formed by the recent gap down, roughly between $220 and $230. A move back above $225 on strong volume would be an early sign of a short-term recovery, but significant resistance lies up to the pre-earnings close of $234. On the downside, the current price is testing major support at the $210 to $212 zone. A breakdown below $210 would likely send the stock towards the next historical support levels, potentially in the $190 to $200 range seen earlier this year. To be bullish, we need to see clear signs of a reversal, perhaps a strong bounce from current support with increasing volume, or positive news regarding AWS AI developments. For a bearish outlook to continue, a decisive break below $210 is crucial, supported by continued high selling volume. Short-term traders might look for opportunities to short on bounces to resistance, while long-term investors should await clearer catalysts or deeper value. Keep an eye on any further comments from CEO Jassy or new strategic partnerships in the AI space. Future earnings reports, particularly focusing on AWS and AI performance, will be the ultimate determinant of Amazon's next significant move. The current setup suggests high volatility, making precise timing crucial for any trade.